Hello again and welcome. This is Robert Schein, Managing Director and Partner of Blanke Schein Wealth Management. Today is March 29th of 2022, and we have markets are moving specifically in the 10-year Treasury and the 2-year Treasury. We call that the yield curve all along the Treasury markets. And the fixed income markets have been extremely volatile year to date, as well as the equity markets to follow. But the main event, the main show, the one that you all want to be paying attention to, at least we are here at Blanke Schein Wealth Management, and markets are, is not the stock market. That's the sideshow. It's the bond market. It's the fixed income market. And obviously, Federal Reserve has been trying like heck to raise interest rates. Why would they want to raise interest rates? Well, they're trying to slow the economy. They're raising interest rates on the short end of the curve, pushing yields of the short end, the 2 years, even the Fed funds rate specifically, which is basically overnight rate, and pushing it up higher. But that also puts pressure across the curve. In fact, if you look at the yield curve from the 2s, the 10s, and the 30s, and the 5s, we've never seen such a curve like this in quite some time, in many, many years. In fact, one going to argue we've never seen this before. And it's quite possible because we've never been here before. We've got $9 trillion in the balance sheet that the Federal Reserve has to reduce in addition to raising interest rates. Why does the Federal Reserve want to raise interest rates? Well, they have to because of inflation is out of control. So you have to have real rates on the short term higher than the inflation rate. And right now we have a 7.9% inflation rate. We could even get the reading for March later in April, later this week, which could be even hotter. It could be 10%, which just means that the Fed is well behind the yield curve. Now, what does an inverted yield curve actually mean? This is an old poster, old by meaning last week I used it because we were predicting or projecting what, or interpreting, if you will, what the fixed income markets were telling us about the future, sort of the economic future for the US here. And it was indicating when we get closer to an inverted curve, and that's essentially when your short-term rates are longer than your longer-term rates. So in this case, we measure it by the 2-year Treasury to the 10-year Treasury. And you can see the difference is getting closer by the day, week, month, and even year, as I pointed out last week. And today, we are not at 20 basis points. We went down to 5 basis points overnight and 8 basis points as I speak, which means we're within a chip shot away from inverting the yield curve. It could happen overnight by weekend. It could happen in 2 weeks, first 2 weeks in April. We don't know. But the trend is not our friend in the short term as it relates to the fixed income market. Now, Rob, what does that mean? How does that play out to our portfolios? How you're positioning? Why do I even care? Like, why does the yield curve slope matter? I'm glad you asked. Well, reality is that historically speaking, economists have been using the 2s and the 10s yield curve as a leading forward indicator for the U.S. economy, whether it be positive, negative, or even neutral. In this case, when it inverts, not every time, there's 3 times post-World War II where it hasn't, when it's inverted and it hasn't caused a recession, indicated a recession where it is basically a false signal. But when traditionally speaking, more times than not, when the 2s are higher, the short-term interest rates are higher than the longer intermediate-term interest rates, that indicates in 12 to 18 months later, historically speaking, a recession is on the horizon. Now, why would that be? Well, you have growth slowing down in future months. Now, markets are a predictor of this. It doesn't always happen. And again, we're going to sit here and say there's potential that the yield curve has been manipulated not only by the Federal Reserve, but also by traders on the fixed income market and shorting the 10-year Treasury. We're not going to get into that, but really the take-home point is this has been the most predicted interest rate hike, and we know because we're looking at commodity prices, food and energy prices, everything's going up from real estate to everything. And now we know that the traders are all basically piling up to make a bet that interest rates were going to go higher, and that's what they're doing. And so we see sort of a pile-on effect, and this basically bacon-shaped yield curve is sort of what's happening. Now, we will see and position accordingly our clients as it relates to the yield curve inversion. And good news is there's a report out by JP Morgan even this morning that's saying, hey, listen, the yield curve, every time it inverts, not every time, but historically speaking, if we look at history as our guide, 12 months later from the inversion point, equity markets are up on average of 15%. Now, why would that even be? Well, think about it. We've already had January, February, and even March extremely turbulent in the equity markets. The equity markets could be pricing in what we could be seeing or experiencing later down the road. So a lot of the sort of fear that we've already experienced and the pricing into lowering multiples or pricing in worst case scenario, as markets do, get to the point where, oh wait, it's not that bad. So we can see, we've already seen markets rebound, retracement of 50% of what we saw the drawdown on the equity market year to date. Obviously we have quarterly rebalancing right now, so that's sort of helping equity markets for the next couple of days. But then we have April with the earnings season. I think corporations are going to tell us that they're earning more, potentially. Who knows what the bottom line looks like? They have to manage their input costs or inflationary costs, wage inflation or supply chain, so on and so forth. But I think on average, we're going to see equity markets perform sort of relief rally, because I think corporations are actually going to perform better than what they projected or even guided. So they guide guidance down and they overperform on the upside, and that's traditionally what we see. So we could see April actually turning out to be even better than the way March is actually ending up. Now, as we go forward with an inverted yield curve, what do we have to pay attention to? Well, what's going to happen is, and as our own Stephanie Link at HighTower has said even this morning in our call with her, she basically said, hey, listen, you're going to have to dial back the financial media, okay? Turn it off. Okay, stick to your plan, have your investment solutions, your strategies, and work with us here at Blanke Schein Wealth Management to, if you're worried about it, let's have that conversation. Let's review your plan. But the financial media, actually there's a report out that shows, and what Stephanie was specifically relating or pointing out to, is that we're going to see in the media all the headlines go up. So all of the financial media, and what I was referring to is how much the recession word is going to be now at the top of the mind of the newspaper, the daily business journal, the TV, even every social media platform, and you're going to see this everywhere. It happens every single time. Now, we're said this even a few weeks ago. We said this last week. We're talking about it today, and you're going to see it now pick up some steam as it's going to make it from the business page to the front page of the headlines. But the good news is we've already positioned for this here at Blanke Schein Wealth Management for our clients. We're already ahead of what's going to be on the financial pages, if you will, to the front pages. And as Stephanie obviously points out, just take a step back, stick to your long-term view as we do here, and let's see how we could take advantage of market opportunities as they come to us when we have the volatility, the disruptions in the fixed income market, and then subsequently the disruptions in the equity market. So that's our viewpoint today. That's our sort of update from last week's sort of work on the board here, and we're using it now because it's still relevant today. You're going to see it more and more. I'll refresh the board for us, but the bottom line is we believe the yield curve is going to invert. We believe the financial medias are then going to officially talk about a recession potentially, but that doesn't always translate into all negative, both on the fixed income market, on the equity markets, or even for our clients in the future. So we'll see how this plays out. But we're going to stick to our long-term view on this, and we're going to have a balanced approach to how we navigate through the financial market. So thanks for watching today, and we'll catch you again next time.